welcome back. You're watching The Money Show with me, Kavita Thaplial, and there are plethora of funds available in the market to invest your hard-earned money. But how do you assess which is the right fund for your portfolio? What are the criteria that one should look at to help you navigate through this maze? We have on board Gautam Kalia, Senior Vice President and Head Super Investor at Sharekhan by BNP Paribas. Also, do not forget to send us fuller queries on our WhatsApp number, which is 865-797-4571. You can also email us your query on themoneyshow@etnow.tv. So, Gautam, good evening and welcome to the show. We have our first caller on the phone line with us, Anshuman. Hi, good evening. Okay, so I don't think we have Anshuman on the phone line with us, but then I think you have his question, and he says that he wants to invest in a debt fund for the period of 1 or 1.5 years. He also wants to know the kind of return expectation he should be having from a typical category that you might recommend him as far as a debt fund is concerned. He wants to invest almost 15 lakhs and half amount can be there for 1 year and other half can be for 2.5 years. That's how he plans to divide this 15 lakhs. So what will be the strategy for him?
So Anshuman, typically when our research looks at funds, especially the debt side, we look at debt as an alternative to fixed deposit investing. So we don't really focus that much on how much additional return can the fund deliver, as much as we focus on the quality of papers and the liquidity of papers that the fund holds. So when it comes to selecting debt funds, we say, it's better to play it safer because you can take additional risk when you by investing in equity asset class. So really that's our philosophy at Sharekhan. So on the debt side, I understand that you want to invest your half amount for about a year and the other half for about 2.5, 3 years. So obviously I would suggest that the amount that you're planning to invest for longer, please keep in mind a 3-year horizon so that then you can get the long-term capital gains benefit. So you get lesser taxation. On the shorter end, I'll tell you for the 1-year part, you're planning to invest about 7.5 lakhs. You can look at HDFC low duration fund, and you can also look at an arbitrage fund. So it's not a debt fund, but from a taxation perspective, is more effective, and you may end up getting about 0.5% return more. So you can look at Kotak equity arbitrage fund. So technically not a debt fund, but that's a good alternative when you're looking to park money in the short term. If you don't like that alternative, you can put the money in HDFC low duration fund. For investments over the longer period, where you're looking at maybe 1.5, 2 years, like I said, if you can 3 years, nothing like it. But you can look at ICICI Prudential Savings Fund and the Aditya Birla Sun Life Low Duration Fund. Now, in all these 3 debt funds that I've told you, the YTM is above 7.5%. That's across low duration, I2 savings, as well as Aditya Birla low duration. So they're good funds, large corpus with decent, healthy YTM. So I think these are the portfolios that you can look at.
All right, we don't have Anshuman on the phone line, but I hope he can just note down these queries later on by watching the show on the YouTube. We move on, Gautam. We will take Ajay's question, and he's investing 6,000 via SIP, and he wants to collect a corpus of 5 crores in 20 years. And he has PGIM India mid-cap opportunities in his portfolio. He's investing 3,000, Tata India Pharma and Healthcare, 1,000 rupees. They're going in SIP, and Kotak Small Cap, 2,000 SIP. He wants you to review his portfolio and how much would he need to invest more to collect 5 crores in 20 years. Can you elaborate on Tata India Pharma and Healthcare before we check on the portfolio?
Yeah, so it's a sectoral fund. Pharma as well as healthcare is going to grow as an industry over the next decade, especially with all the lifestyle associated diseases, with all the fast food and all the lifestyle impacting habits that we are developing. So obviously that's just a macro trend that will continue to support and boost this sector. So we save money on quality of ingredients, and we end up eating bad ingredients, and then we spend that money on more healthcare. So essentially we are in that, we are at, maybe I won't say start of the cycle, but that's something that is an emerging trend. So the fund is obviously capitalizing on it. It's a very niche sectoral view and not necessarily something that he needs to stick with, especially when you have a long-term view. So you don't really need a sectoral theme. It's more if you have a tactical view, then that's separate. But for the core portfolio, not something that I would suggest that you stay invested in. But as a fund, it's okay. So really, his call whether he wants to Ajay wants to stay invested. But other funds are also okay, so he can continue. There's no large cap allocation in his portfolio right now. So I think a couple of things to begin with. First, increase large cap through like a ICICI Prudential Blue Chip fund, and maybe also look at a flexi cap like a HDFC flexi cap fund. So you can add these funds in your portfolio. When it comes to creating a corpus of 5 crores in 20 years, the amount of money that you have to put in is upwards of 50,000 rupees every month. So if that is too steep for you, because at 12% growth rate, let's say your portfolio generating, you'll probably reach them in 20 years. But if that is too steep for you, then try to increase your SIP amount every year by 10%. But you'll have to increase your SIP amount immediately to about 27,000 rupees a month. You start off with that amount and then increase it by 10% every month. That's when you'll reach 5 crores in 20 years. Else, maybe just extend your horizon if the amount is too much on a monthly basis. But
Right.
definitely, this is not the making of a core portfolio yet. You need some, large cap and large mid and flexi cap to kind of make the core portfolio.
Right. For that, I think we will have to have Ajay call us back and maybe be on the phone line this time with us. We have Pratesh Shah, Gautam, on the phone line. Pratesh, hi, good evening.
Hi, good evening.
Thank you so much for sending us your query. And you want to understand what is better, sovereign gold bond or physical gold?
Correct.
All right. And you are just looking for a 2 years time horizon?
That's right.
Any specific reason?
No, I just wanted to compare this because there are two things in this. My wife believes in physical gold, whereas I wanted to invest in sovereign gold bond. The idea is for 2 years.
All right. I think investment, if you're talking about investing in gold, and I'm sure Gautam also will agree to this, it should not be in physical gold form, be it jewelry, coins or bars. But also if you want to put money in a sovereign gold bond, 2 years is not the time horizon for that.
Correct.
Gautam, over to you.
Correct.
Yeah, so typically you're looking at an 8-year horizon with the option to exit after 5 years. And sovereign gold bonds, especially in the primary issuances, you have to wait for the issuance unless you're buying in the secondary market. The key advantage that you have in sovereign gold bond is obviously that you don't have to worry about managing the physical gold as well as the interest of 2.5% that you get every year, simple interest. Sher Khan house view is quite bullish. We expect gold at currently around $2,000 to go to about $2,400. So we are looking at a 20% increase. From a practical standpoint, it makes a lot of sense to look at physical gold. And if you don't mind paying the making charges, then probably even jewelry, because your wife believes in physical gold, and you can just believe in her and stand by her and probably give her that satisfaction. So not really that much of a price to be put on the satisfaction of owning that jewelry. And if you're not putting in, let's say, gems and other precious stones, where there is a
Gautam,
massive,
what about considering ETFs or not a gold fund, but then ETF? Do you think
Sure,
that?
sure. So ETFs and gold funds are good options. Especially if you're not, if you don't want to go that route of going into jewelry and physical. If you're looking at purely from an investment perspective, if you're trying to maximize value, then obviously a ETF or a simple, gold mutual fund you can look at.
All right, so that's the solution to your query, Pratesh. All the best. And on that note, thank you so much, Gautam, being on the show and helping our viewers with their financial portfolio. Time to sign off, but then I'm going to leave you with our WhatsApp number and email ID where we keep waiting for your portfolio-related queries. Thank you so much for watching. Goodbye.